I actually had to personally borrow some of the money to close the transaction, but I didn't have anything to back up the loan. I think that's one of the benefits of coming from nothing, is you're not afraid of what that's like. Raising money and raising capital from LPs is difficult. Investing it is easy. Selling it is hard. I enjoy the grind. I enjoy the wins, but the losses haunt me. Don't chase paper gains. Don't follow the herd.
Today on Billions, I'm sitting down with Larry Aschebrook, the guy who invented a market that Wall Street didn't know existed. Larry started personally buying shares in Twitter and Uber on the side, and he realized there are thousands of employees sitting on life-changing paper gains with zero liquidity, waiting for companies that might never IPO. So in 2011, he quit his safe university job and launched G Squared, a fund to solve that problem. Nobody took him seriously. The secondary market was taboo. Companies thought selling share meant you were failing. Today, he manages $5 billion. He turned a $150 million Spotify bet into $1 billion, also made $800 billion on Coursera, and the market he built is now worth $140 billion a year. Larry, welcome to Billions.
Thank you. Thanks for having me. Excited to be here.
Yeah, I'm really excited to understand, how all of this started. So initially you spent a lot of time in your career raising money for university endowments. And then after you started buying shares on the side, you started to see a new category. Can you walk us through a little bit more about how you made your first investment and how you made that happen?
Yeah, I wish I could say when I started the business that I had some master plan of how it was going to all go. And I have to tell you, early on, people thought I was crazy and that I had lost my marbles, so to speak, when I walked into a very safe job that I had spent 10 years building a career in and was at the pinnacle of, and just quit. I think what I realized early on, which is still the same today, is these companies that we all are really fascinated by. Every year or two, there's a new batch of them. But in the beginning, it was basically the companies that were starting to run our lives via the smart devices we were all so focused on. And I was no different. I was a major consumer of data just through my smartphone, and started to change the way I consumed and behaved. And I thought there was an opportunity to share in that value creation. Little did I know how hard it would be to access some of these businesses, but I think just grinding and not taking no for an answer and really being naive, I think, was a godsend. Because if I knew then what I knew today, I probably wouldn't started the business.
So when it's 2011, you want to make an investment in Uber or Twitter at the time, how do you do it? Do you message the founder directly? Do you send emails to employees?
There wasn't a robust LinkedIn back then. It was the universities I worked at all had alumni lists, and I worked at 5 different major universities around the country in the U.S. And I had those lists of alumni, and I just started calling them folks that worked at Twitter and early Palantir and Spotify and early Uber and many others, and just started offering to buy their stock, and didn't really know how to actually go about doing it, but just kind of made it happen.
So I own a software company, and obviously if an employee wants to sell their share, the company always has or in most cases I would say a offer. How do you overcome that?
Well, early on there wasn't, it was so taboo, as you mentioned in the intro, that it wasn't widely done. I mean, secondaries, now I know, were mostly reserved for fund stake purchasing and also large PE deals. The growth venture ecosystem really didn't have many secondaries. In fact, there was the new regulation coming out following the financial crisis for managers who spent their capital on the secondary market that most traditional managers wanted to stay away from. They were afraid of that. Now you see many of many managers opting in for the registration. And so I think that there was just a broken market. And employees, like the idea of liquidity, and companies just kind of turn their back on it and didn't really care. It was so small, it wasn't meaningful in the beginning. Now the industry has really evolved, and we're thankful to be one of the first movers to now be in a position to get the phone call versus making all the calls.
So now, how exactly does that work? Like versus back then, when you want to get into like a secondary
Yeah, well,
transaction?
I wouldn't advise anyone on deploying capital the way I did on the early days because it was mosaic theory. It wasn't full information. There was very little connectivity to the actual management team members. Today it's very involved with the management team members. We partner with the issuers. We work with them directly. We support them staying private longer. We have a whole toolkit that we've developed over 15 years to really help the company stay private longer. It's self-fulfilling, of course, because we could do a lot of work on the secondary market then. But yeah, the market's mature today. In the beginning, it didn't exist. And so today we underwrite like a primary investor. We want to touch and feel the companies. We want to talk to management. We want to have full data. In the beginning, it was hiring some analysts out of, India to write memos for me. And when I was working during the day, they were sleeping, and they were working at night when I was sleeping, and it worked well. And there was really a business of one in the beginning. And now we've got very thankful to have such a tremendous team at G Squared, and the growth has been unprecedented for us over the past several years. And the returns have been very good for our LPs, and we're kind of at the sweet spot of the intersection of really awesome businesses and access. And that, to us and any manager in the space, primary or secondary, is what you're searching for. And in some cases, that is the definition of success.
Nice. And can you walk us through maybe like the whole like Spotify story, because I know it was a big bet of yours in the early days.
What an incredible business that Daniel and team have built at Spotify, and continues to amaze me today, especially now with the kind of integration of full agentic AI into their business model. It continues to evolve and just inspire artists and compensate artists around the world. So congratulations to them. In the beginning, like all the other early investments, I loved consuming music. Got to know Spotify through that as a consumer. Wanted to buy stock. Found employees that had shares. Sent the notice to the company, and they didn't respond. So, I think for me it was natural. Others say is probably not so natural, as I just got on a plane with a young analyst that worked with me at the time and went to Stockholm and begged for a meeting. And finally they gave me one. And that's how the journey started. And
So you went to their office, or
yeah, went to their
yeah?
office, stayed, no appointment, just kept showing up day after day. And finally, a young legal officer, I think, took pity on me sitting in the lobby and my colleague, and invited us back and basically told us that, there wasn't an opportunity. And we just kept asking, and eventually they started sending a bunch of sellers to us. It got to a point where we put up a sign in their break room that, we will buy your shares. And I think Spotify and a few others were early in this movement to embrace the idea that you could stay private for much longer than most, help your employees, keep them from going to other public tech companies where there's value immediately in the paper they hold. And it was a good marriage for a long time. There was some stress along the way. They sent us some really large blocks of stock that we were so small we didn't have the ability to buy right away. And we went out and traveled the world and raised the money to close it. And it were very fond memories for me, the Spotify journey. And when it went public, it was a massive celebration for the company, but also for our business. It really changed the trajectory of G Squared.
So did you like keep the shares of Spotify after like it goes public, or how exactly does that work?
Yeah, so for us at G Squared, we're focused on a kind of cash in, cash out situation. So we send cash to our LPs post public. Sometime we develop a strategy on slowly moving out of the position after the company doesn't need our support anymore. But building that position in Spotify was one that I think really set the framework for how we were going to establish our business going forward. Now, it came with a lot of stress. There was a very large transaction they sent to us. We didn't have all the money. We had to find it. In fact, I actually had to personally borrow some of the money to close the transaction. But I didn't have anything to back up the loan. So I put a lot of risk in it, and it worked out. It
Yeah,
was,
great reward.
yeah, I mean, it was a very tense time in G Squared's history. But the conviction.
Did you have like such a conviction at the time, like that your loan would be reimbursed? Like, how do you build like such strong conviction on a company? Was it because you had access to all the data and you knew that it was going to be a hit, or like?
Well, there was a lot of stress in the market related to streaming services at the time. Obviously, Netflix had gone on to a fantastic journey, and that kind of laid the groundwork for music streaming. And Spotify had a number of formidable competitors that still exist today, with Apple Music being the primary one. And you remember there was a lot of noise about Taylor Swift and Adele leaving the platform.
Yeah.
One of I think the benefits today that we still enjoy, and we really figured it out with Spotify and a few others, including Coursera and Uber and Airbnb, was that if you can get the information like a primary investor, you can really use the secondary market to have an arbitrage that the market doesn't know about and buy at your option, not at the company's timing of preferred investment. And I think that's one of the major benefits of secondary direct investing. And in Spotify, there was a point in time where there was a lot of noise, but the record labels were also shareholders. Most people don't realize this. Early on, coming off of the whole Napster debacle, the record labels realized that there was something going to change in their business models. So when Spotify came along, Daniel Ek did a great job and team of getting the record labels on board. Well, as this noise took place, we had data, we had the updates, and we could see that the record labels actually were trying to buy more stock in Spotify. When all this
Interesting.
noise and headlines, and not in small ways, a free cash flow of those record label companies were in the several $100 million a year, and they were spending a significant portion of their free cash flow on buying Spotify stock. And to me, that was the aha moment that, look, they're here to support it. They're not going to kill it. And let's use the market turbulence to buy a bunch of stock. And we did. And history shows it was right, thankfully. And we became a top 10 shareholder at Spotify amongst giants, and the shares that I purchased through the loan ended up being worth significantly greater than the value that I bought them at, and it worked out. I would not advise that to young entrepreneurs trying to start a secondary business today, but that's my mentality, and I went with it. And I think that's one of the benefits of coming from nothing, is you're not afraid of what that's like, and so. It was a great journey, and Daniel and team working with us, developing a strategy to stay private longer, rewarding their employees, and really develop the playbook for us going forward. And that was the foundation that changed the trajectory of our business.
And how did you get the info that the music companies were actually purchasing like more shares? Was it like publicly documented by the company, or?
Yeah, so they had this hidden option really to exercise to own a certain percentage of the company. And I frankly didn't know it going into the investments. I don't think most shareholders knew it. And all of a sudden, one day we got this notice that we were being diluted by 3%, and the company was getting several $100 million from the record labels. And it was right at the same time of all this headline risk. And that just, for a minute, it was a head scratcher, right? You're like, well, the record labels and their stars are leaving. Why would they give the company hundreds of millions of dollars? And then the light bulb kind of went off, and it was like, well, they kind of know what the future brings, and they're going to support it. And let's go load up on stock here.
Nice.
Yeah.
And who did you like purchase from? Like at the time, was it employees or other funds who were looking to get some
Other funds.
liquidity?
I think that, today it's very commonplace that funds have very little DPI, and when this time period was taking place, 2012-ish, 13, 14, it wasn't as a big of a problem. I think some of the large investors got a little spooked and read the tea leaves slightly differently than we did. And there probably was a higher possibility or chance that they were correct, by the way. And they needed, they wanted to sell. And so we found a large block the company sent to us. It was 150 million in size from a very well-known Nordic venture firm. And the Spotify had an interesting transfer process because it was a Luxembourg company. So you would notice your transfer, it would be approved, and then there was like a 60-day settlement.
Okay.
So during that 60 days, we went around the world and rounded up $141 million, and we had we were 9 million short, and that's the shortfall that I backfilled with a loan.
Okay, and that ended up being one of the best investments.
That ended up being a life-changing event. Thankfully, but at the time, half of nothing's nothing. So there wasn't a lot to back up the loan, and so I wasn't too bad off. But yeah, no, it was an amazing opportunity for us that they gave us, and our team worked tirelessly for those 60 days, made it a very large position in our third pool of capital that we had managed. I think it was 40% of that vintage, and 30% of earlier vintage. So concentration, I love. I'm a very concentrated bet person, kind of my personality, and the law of large numbers worked out for us there.
Nice. And how exactly is the whole business structured? Because you started with investing. I'm guessing you had like an early fund, then you raised like several funds, and on each opportunity, when you can increase your position in terms of size, do you like raise with existing LPs? Do you bring like new LPs? Like how is the whole structure?
Yeah, well, in the beginning, the pools of capital were small.
Okay.
The first pool of capital we deployed out of, when total size was close to $35 million. But our LPs, our investors alongside of that vehicle invested several $100 million in co-investment.
Wow. Okay.
As the business grew and we had success, it kind of normalized. And today, our vehicles are, truly committed capital, 2 and 20 funds, about $1 billion, $1.5 billion in size, the last several. And our LPs still enjoy a very robust co-investment business where they top up. Now, we've learned a lot of lessons along the way and how to manage that co-investment, because it can be a big risk to your firm if handled incorrectly, because LPs love the shiny logos. It's, for instance, early days in Uber, great business, but we lost money. And it's a head scratcher, right? Because it's such a fantastic company and we bought it at such a low value, but at the time of the exit, it's just the public market wasn't receptive. Now it's a juggernaut. So the thesis was right. The execution was not. So
because at the time, whenever it got public, I'm guessing you need to like hold the share for maybe like 6 months or something like this post IPO. But after that, for you, the goal is to sell and get liquidity and DPI. You don't have like a structure that says, hey, let's keep holding on those public stocks because we believe they're undervalued.
We're not a public market investor, right? So our value add to companies is helping them stay private longer, consolidating their cap table, doing a lot of tenders, one-off transactions, helping with early shareholders need liquidity. The price of admission, so to speak, is we need the data to understand what we're doing, and connectivity with management. And then the companies, they get to a stage and scale where they need public market investors, and they just have a different, goal and thesis than us. We're building our business still today on a North Star that's a DPI number in a 5 to 7 year period. And that's what we do. A lot of firms and a lot of institutional investors, by the way, are confused by it. But what we're trying to do is build a business that's like the Jim Simmons of the Renaissance Capital. I want to have realized IRRs in the 30s every year, 30% plus, and have a track record of 10, 15 years of doing that. And it's maybe a multiple that's 2.5 to 3x in that period. It's not chasing, 5, 6x multiples over 10 years. So it's just, we're solving for something different for a different type of LP. And the companies inside of our business that we choose to participate in, for the most part, they get it. And they want the help and consolidation of their cap table. And today it's a massive industry and a big business. In the beginning, it was really just me trying to change my life, liking businesses, using the smart device to change how we consume, and trying to find an opportunity to take the little bit of money that I had and turn it into something far more.
And that worked.
Well, not always. It doesn't always work. I mean, we've had some really and when you invest with concentration, 10 companies will make up 80 or 90% of our risk in our funds. There's always the good stories of Spotify's and the Courseras and alike, and Toast and Wiz and Anthropic and OpenAI and all these fantastic businesses. And I hate naming logos because I'm leaving out 50 other amazing founders and businesses that we were supportive of, and they did great work for us and created a lot of value for our LPs. But for all of those, there's, Gorillas and Getir and Pagaya. There's many scars, and 23andMe. And there's
Like,
the one, yeah.
So how can you walk us through maybe like one of the story where it didn't when for example, you start seeing a company that's not performing as well as it should, you're potentially heavily invested in it. I know that because what you were saying about DPI, like I've invested in many VC funds, and obviously like for them, they love to share, paper gains.
Everybody's got the wins.
No.
Nobody ever loses a dollar. I mean, come on, everybody's perfect.
Yeah, exactly. First, nobody ever lose, but also like they love to share, their NAV and how much technically on paper, they've made. But I know you also like balance your portfolio, so maybe we can go to that a bit later.
I think that look, as a GP, raising money's hard. Doesn't matter what your returns are. Raising money and raising capital from LPs is difficult. Investing it is easy. Selling it is hard. And typically, your opportunities to sell are when everybody else wants to buy.
Yeah.
And the herd mentality of Silicon Valley can be difficult to abstain from. And I think one of the benefits we have with being headquartered in Chicago, and most of our team members are Midwesterners and have a different kind of risk tolerance, is it's less about, what is in your book, so to speak, and what dinner parties you go to and how much money you're managing. And it's more about what are you doing to create real value for your LPs, true alpha. And that is a difficult item to find. It's real, true alpha generation, not beta. And so as the markets are up and to the right in privates, just like publics, it's not alpha. people can pat themselves on the back all they want, and we've been guilty of it too. Well, we're so smart, we're so good, everything's working. Look at the MOIC. But the real true outcome is what is the value of it when you sell it.
Yeah.
And in some of those losses, painful ones, and I wear them every day. And I have a terrific co-PM in Spencer McLeod, who's, I think, besides my wife, one of the smartest people that I know. He does a fantastic job of helping us build our portfolios. I think my value add to our partnership is my willingness and desire to do the hard things. And I think that's from being a former athlete. Like the grind I enjoy the grind. I enjoy the wins, but the losses haunt me. And when I look back at the failures at our firm, even with good process, you're going to have bad outcome. I can handle those. It's the bad process that creates a bad or good outcome. You don't reassess on the good outcome of the bad process. It's the bad outcomes that you really look in and say, hey, what did we do wrong? And how in our business, secondary focus, 70% of our funds are secondary, try to underwrite like a primary investor. So we can't use the excuse of we didn't have enough information or we didn't have a interaction with management. It's truly our mistake, and it's the price we paid. Because in like one example, quick commerce, we had a lot of success in Instacart and Postmates, Meituan, Diaping, Alibaba. We had great success. Pandemic happens. We deploy over the course of 18 months a lot of money into quick commerce. And we all know how that story ended. And we were not immune to it. And so as I look at the process, were there points in time that we could have exited our positions? And the reality of the answer is yes. And we didn't do the work that we should have done for our LPs on that particular space. And those are the things that we have to make sure that we improve upon and put guardrails in place to not have happen again. And
So
those
now
are
do you have
helpless.
like yeah, sorry, go ahead.
No, go ahead. Yeah.
Now, I was wondering now, do you have like very specific rules? So for example, let's say you mentioned like companies like Anthropic, OpenAI. I mean, we've seen like the scale and how fast this valuation, I think now we're entering, like an era where valuations are going through the roof. Like to access Anthropic, like the last round, I'm guessing they were not looking at investors below like 1 billion, in terms of check size. So how do you, if you have a position, in these companies, when do you decide to sell? What amount do you sell? Do you like reinvest? Like how do you map out like the strategy?
Yeah, first of all, in those two businesses, fantastic value creation for LPs every day, and for their shareholders and their employees. Congratulations to both of those businesses, and we're fortunate enough to have exposure to both. I would say, the rules of the game are really changing, but as we're playing the board game. In valuation and growth and underwriting and cash needs of the, AI native businesses. It's something as as GPs, we've really not seen before. And it's very difficult to underwrite. What I would say about those two assets is they're probably, still in their infancy. So the majority of the people that got in at the right time are going to have a fantastic outcome. Just generally speaking, for G Squared, what we're after is a North Star of this 2.5 to 3x DPI in a 5 to 7 year period. And as we start to achieve that per fund, you see us starting to de-risk. Now, in the high flying assets, they typically have an outcome that happens on their own quickly. There's no gravity holding some of them back. Wiz showed it with their Google acquisition. Was a fantastic position for us. It closed recently and really got to know the founders through trips to Tel Aviv, and they trusted our process, and we built a very large position there, and we were fortunate to have an outcome that was generated for us by the company. But for the most part, we have to focus on selling at the right time in conjunction with the company's needs. And so I think one of the struggles of running a concentrated equity portfolio, primary or secondary, is when it comes time for you to meet the needs of your LPs, you have to do it in a way that's beneficial to the businesses. Making sure that if you are transacting, you do it with very high quality third parties that can provide value to the companies differently than you.
Okay.
And Coursera.
So basically, you go with you go to the board saying like, hey, I've got, let's say, a very well known like family office who has great connection in that specific region, would like to acquire like let's say 100 million of my position. I think it can be like a helpful partner. Like, can we make this happen? Or is it?
So it's family offices to large global financial institutions. Coursera is a great example. We were, I think, we're the largest shareholder of Coursera at the time it went public, and we worked with the company and a very large sovereign wealth fund to come in and transition our position to them. So we didn't, sell it and drive the stock down over, 180 days, because I think that's one of the issues in the public markets today is there's just ultimately no liquidity for large scale positions. So, you think about, and we're small, right? And still small, we're bigger than we were, but in reality, G squared, we're approaching 7 billion today in assets. It's still relatively small compared to some of the other players. But we do build very large positions. Several $100 million of cost basis. And in the case of some of them, it gets to be north of $1 billion in net asset value in one position. When you go to sell that in the public market, it's almost impossible without moving the stock price. It takes forever. And if you are unlucky and have one of those great businesses go public in Frankfurt or the LSE, there is not enough liquidity.
It's not possible.
There is no liquidity. So this idea that the public markets create massive amounts of liquidity for GPs at large scale is really false. It's a false narrative. And so what we've decided to do in our business, focused on this DPI metric, is when it's time, we work with the companies, we find shareholders that they want to get involved with, and we help transition it to them in a win-win. Similarly to what they did for us building the positions. Now it takes time and energy and patience, but ultimately we are stewards of trust from the issuers. And
do you negotiate that from the start with the company? Because I'm assuming that obviously when a company gets to a stage where it's like super sexy, everyone wants in, and they just want to raise, and they don't want like existing shareholders to get liquidity.
It's much easier on the way out than it is on the way in. When our business model is we refer to it as the land and expand. You kind of fire the rifle to calibrate the cannonball, so to speak.
Okay.
So we're dollar cost averaging in, very small positions up front. It's when we get to the top 10 or so per fund where we have, $200-300 million of cost basis in a position, and we need to then start to trim it as it gets to massive in scale because we have to have risk controls. Companies understand that at that point. In the beginning, if I were to show up and say, hey, I'm like, I love your business. I want to buy today, and 18 months from now, I'm going to sell the position to somebody you don't know. It's going to be much more difficult. And then you just can't. You can't operate that way in our industry today. It is back to a club mentality, but it's more new line growth managers than I would say the old line traditional VC firms, with a few exceptions.
And when you reach that 2 or 3x in DPI, is it like per fund or is it per position that you look at it from a liquidity perspective?
Yeah, I mean, our fund models will kind of tease that out, but it's a holistic perspective on the pool of capital. Now, each individual line item you need to meet a certain return, but they balance each other out. And still within concentration, we try to democratize the return a bit, but it's difficult across our 4 mega trends. They have different themes within the mega trends that are more, you know, are more prevalent during a certain time period. It was heavy consumer in 2015 through 18. Then it was a lot of SaaS in 2020. 2022 vintage has, everything is amazing because we bought everything when the house was on fire. You
Yeah.
know, there's you look at all the businesses, you're like, "Oh, we're so smart." Well, no, I mean, we were,
Everyone was scared.
everyone was scared. And that's, as a secondary market player, that's when opportunity takes place is when you have really high 10-year yields and federal fund rates, and you have everybody running to cash and commodities for safety. It creates real buying opportunity. And then today it's in the AI native businesses, which are unbelievable. But along the way, there's things from, SpaceX to Anthropic to Spotify. And of course, all of these businesses are unbelievable to be around, and the energy that the management teams bring and the value they create for their shareholders and their employees is unprecedented. We're just a steward of that during the process.
And like earlier you mentioned the fact that public markets didn't have or don't really have now much sense, even when you look at liquidity and how liquidity is managed. We're seeing some companies, I don't know, if you look at Stripe, Revolut, etc., sometimes I'm wondering, why would they go public? They do tender offer every single year. They can get liquidity for existing shareholder, employees, etc. They don't have the pressure of reporting of public market. They can keep, long-term vision.
Yeah.
So from your perspective, because you've seen that market evolve, what does make one company go public? And do you think that's going to change over time?
I think when companies access the public market, it's for their own reasons, and all of them have probably unique ones. Companies today that are accessing it for raising of capital likely have some capex intensive business model they need to support, and you start to see some of the conversations today that are happening in the public media around some of the big private assets. It's really the ones that require an enormous amount of cash still to continue to grow and to service their customer bases. And I think for the most part, segments of the new revolution in the AI industry have that. And those businesses are probably going to be better served as public companies. Companies like Stripe and Revolut, although they have an enormous amount of AI embedded in their DNA, what makes them great. We were fortunate enough to be early in Revolut, and we're in Stripe as well. Those businesses accelerating at scale is probably the most impressive that are profitable. And there's many of them like that. So, I'd throw Databricks in that group too, where you can stay private, not live your day in 90-day increments, invest in R&D, have great profitability, have programs for your employees that are similar to open periods of selling their stock as a public company, and not have to deal with the majority of the cost or the pain of being public. And I like to think that we're a small part of helping those companies do that from the beginning, helping kind of write the rules and the processes within the tender space and the secondary space, and seeing it flourish the way that it is today in these fantastic businesses, and the reward that the employees are getting and shareholders for creating the value is very rewarding for us.
And maybe it's a very European thing to say, but do you think at some point there's going to be a regulation coming into play? Because if you look at, so I invest also in secondaries through friends connection or whatever, but what I'm seeing, it's the moment, Anthropic was at $380 billion valuation. The price of people selling on secondary market starting climbing. At first it was like 400, then 450, then you see blocks of 500, 550. So the markets, like on private market, there are like definitely like no rules. Things can be kind of like manipulating and changing. So
Yeah,
what do you, yeah.
I think part of that is, I call it chasing ghosts internally, because a lot of what you're saying is noise, and it's not real. It's kind of the retail movement trying to get access to a very tightly controlled um, business and cap table. And so you see that in many of the businesses that become mainstream is logo recognition.
Yeah.
I would say Elon-backed businesses have taken it to a new level of this, and others have seen that business model and are replicating it. So I think from a regulatory standpoint, yes, Europe loves their regulations. We have a business in Europe. We've had an office in Zurich since 2017. We've backed many of the terrific businesses in Europe and the founders. And I think what you'll continue to see is a significant number of those founders continuing to come to the US to set up their businesses and operate, because the shareholder agreements are more flexible, raising capital is easier. The regulatory environment to operate in is less controlled. I don't see a very heavily regulated secondary market. They're private transactions. It would be like controlling you selling your home to someone else and then having regulations of somebody, just the government deciding how you can sell it and when you can sell it. That doesn't seem like a democracy or free trade to me. So I don't think that happens. What I do think will happen and continue to evolve is the idea of some type of exchange that works. Today, there's a lot of ideas and a lot of capital flowing into it. Outside of kind of the tokenization, there's issues with exchanges to trade private securities, mostly because of the settlement. We don't have a T3 settlement period. The best you can get probably is a T14. And that's
What does that mean? What does that mean? Like,
that's the transaction plus settlement. Like in the public companies, if you buy a share of Meta, it settles within 3 days. The stock trades hands for you, right? So in the private markets, that doesn't exist. It's all paper still, right? Robinhood has figured out how to tokenize it, and others, and that's super interesting. But at the end of the day, you're not owning actually any paper of the companies. And until, specifically in Europe, until the early stage managers in Europe change the way they deploy capital into companies, you're not going to see a very robust secondary market, and you're not going to see the ability for companies to have an opportunity to get to the place that would be the holy grail, is a trading platform. In the US, we're probably closer, but I still don't think I'm 48, 15 years in managing G Squared. By the time I decide to walk away, hopefully 20 years from now, I don't think you'll still see it because it's very difficult to settle private transactions. And the way the shareholder agreements are constructed, it's nearly impossible to do it outside of approvals that are needed.
And what I've seen, in private market is a lot of different layers. So with G Squared, I'm assuming that you're always like direct cap table. So you have like the proof of shares, everything is super clean. But what we're seeing is like layer 1, sometimes layer 2, sometimes layer 3, and people like exchanging, those shares just because it's easier, and it doesn't, it's not under the company's right to choose like who's selling, who's not selling. How do you see like that kind of secondary market, but that's a lot more on the layers of SPV?
The shadow market, the SPV market. Look, I think that's going to be very difficult to control. I think as anybody out there is trying to buy stock from someone, know what you're buying, do as much research as you can. It reminds me today of similar to when the first kind of craze was happening with this, with the Twitters and the Facebooks and the LinkedIns and the Spotifys and the Palantir, this early movement that took place in the 2010 to 2014 period. And when it all unraveled, there was a lot of fraud. And I think in retail investors that are out there that listen to your podcast, or just even small firms, like, be careful, partner with good partners, do your research, do your due diligence, dig in, and know what you're buying. And I think that's the biggest issue with that.
So your process, if someone is entering like a layer 2 or something, it's to check who's on top, like make sure they have the proof of fund, etc., etc.
Yeah, if I were in one of your listeners' shoes, I would start from the first entity. I would dig through it. I would ask for all the documents. I would get all the way down so you can follow the tree all the way to the cap table, tie it out, get audited financials of each of the vehicles. It's onerous, and most people don't do it. And there are these SPV shops that are out there that this is their business, and many of them are great. And they serve a place in the ecosystem. But there are, not so great ones.
Bad ones.
And people need to pay attention, and they need to do their own due diligence, because there will be, in my opinion, stuff that comes out as these companies get liquid, and it's inevitable that there is some bad actors out there. So as investors want to play the space, go to the reputable firms that do it, and there are those out there. And find an opportunity.
So when you decide to sell a position, do you actually use continuation vehicles, or do you
we
sell
tried that?
Okay.
We tried one. And I would say that industry needs to evolve from where it's at, especially in the growth tech space. The process that's currently put in place for CVs, and I understand why they exist, and it's a good business, and there's good returns to be had as the investors in those vehicles. It's currently structured for a PE-like transaction, not in the world that we live in every day. It's currently not set up to have success with managers that have underlying assets that 3 months is like 5 years in traditional industries. The assets move so fast. The best assets in the world are achieving greatness on a daily basis and growing at unprecedented rates that most of us haven't seen before. And when you overlay a complex M&A-like CV process, because that's what it is, it takes months to get done, it puts a lot of risk on the transaction. We did one. We had it very all the way to the finish line, and we ultimately didn't close it because of the underlying assets moved so much. And you also need the full support of the underlying portfolio companies, which, in our space, they're very protective of who gets on that cap table. And it becomes very difficult to get some of those transactions completed. So I do think the CVs, as an investor, because I'm an investor personally in some of the large players in the CV market, and they do great work and there are great people behind it, I do think the process needs to evolve. And I think if those players want to be more and more around the hoop, so to speak, with the logos that are getting all the attention today, they have to change their process, because it just fundamentally doesn't work. For a
How
GP.
would you change it? Like, what would you change in the
It needs to be handled
continuation?
like a traditional secondary, not an M&A. It just needs to be very simple. It can be done in a matter of weeks. It shouldn't take 6 months.
Okay. So it's like selling shares, putting them into a new vehicle,
Yes.
and then okay.
It's very simple. It no different than if you and I decide to transact on an individual name. Just transact in 10 names, real quick. Because time kills everything, and in our space,
Time kills deals.
3 months. You just look at some of the businesses and their performances that have been publicly announced. In 3 months, it's
insane.
It's the movement is the company's raised 2 rounds of capital in 6 months.
Yeah.
So
it's insane. And whenever you look at the valuation that we're seeing today, So yeah, Anthropic close to like 400 billion, SpaceX more than a trillion, OpenAI close to a trillion. Like, how from investors' perspective do you like value these businesses? So for a lot of people looking at SpaceX, they might think, like, okay, it's doing 15 billion in revenue. How do you make up, that huge gap between the 15 billion
Guillaume,
and
it's the
the,
TAM. The TAM is so big. No, I'm just
yeah,
yeah, look, I think it's a struggle, right? It's you're paying today for growth tomorrow, and you have to do your own work and decide what's the right value to enter, and if you can get access at that value. I would say it's some of the AI native businesses are easy, the larger ones, the first movers, the clear leaders, consumer enterprise level, and the two LLMs you mentioned. They're probably a bit easier to underwrite at those prices. And SpaceX is now a complex business. It's when we invested back in 2014, it was like, we want to, win some NASA contracts and build some spaceships. That it's very different today. And the scale of it, by the way, is unbelievably massive. And
yeah,
congratulations, talk about the ability to create something that nobody thought was possible. It's staggering to think about.
never bet against Elon. I
No,
guess
it's
this is
just and never bet against Elon is a good rule. I'm going to add that to that. We have the G squared 8. Now it's going to G squared 9. Don't bet against Elon. Exclamation point. And my friends at Valor Equity would say, Larry, and listen to Guillaume. He's absolutely right. So, but yeah, I think
awesome.
it's difficult fundamentally to underwrite. So how we do it is we use public comps. Of course, in some of these assets, there are no public comps. You have to use a basket of comps. You have to see what you've invested previously, and think, the history doesn't repeat itself, but it often rhymes. The characteristics of great businesses really don't change. If they can generate, a significant amount of free cash and they're still growing, they're good businesses. It's just a
Yeah.
matter of what price you pay, and can you get involved at a price of safety and a margin of safety embedded in it. And that's what we pride ourselves on doing. And sometimes we miss. We don't get the shiny logo because we can't underwrite it. And other times we come back around. You have terrific business. It's been all publicly reported in Stripe, and it's accelerating at scale. And that's unbelievable to see a business where 1 out of every $60 that transacts on the internet flows through their platform.
It's insane.
I mean, one of the businesses that got away early on, and now it's like an opportunity, but 9 years ago we could have invested in Stripe, and how stupid was I for not doing it? It's like when the Spotify founders introduced me to the founders at Klarna, and I could have done it for $250 million valuation, and I passed. So
Yeah,
dumb.
I mean, I think we're almost running out of time. So to conclude, like, what would be one tip you could give to anyone, like starting a business from scratch and wanted to build something ambitious?
I think it's all about your teammates. Hire grinders that will do anything to win. People that have had adversity, ones that will show up and have a chip on their shoulder every day to try to prove the world wrong. And founders of businesses, we often back 2 founders trying to solve the same problem. And it's almost always the founders and team members that have that edge that win. And they might not have the best product. I think of Turo. When we invested in the car sharing platform and rental car business, and Turo, we also did Get Around at the same time. Turo's pitch deck was something like, our children probably put together. It was terrible. But the founders and the leaders of that business were grinders. And today, one is here and accelerating, and the other business is gone. And the other business raised way more capital, had all the shiny things, all the great investors, and it didn't work. And it's just a true grind mentality. There's that. And then from the GP perspective, steal a line from my friend Mitchell Green at Lead Edge Capital, who says all the time, and I believe in it too, which is investing is easy and selling is hard. You have to sell your winners in order to have a sustainable business. The idea that you can wait and hold and have paper gains and be a new fund manager and go raise a bunch of money, it is difficult as a seasoned manager that has a robust DPI that's in the top 10% in our industry per dollar invested. It's very difficult to still raise capital. Don't chase MOIC. Don't chase paper gains. Don't follow the herd. That's what I would say. It served me well.
Awesome. Thanks a lot, Larry. It was really great chatting with you. Where can people follow you? Is it what's the best platform to follow you?
Our IR team does a great job on our LinkedIn page and our website. I'm pretty off the grid. You can find me at larry@gsquared.com, but I'm not an avid tweeter. I still call it Twitter. Still dear to my heart.
In your heart.
In my heart, it's Twitter. But you can find me if you need me. But really appreciate you having us on. Humbling for me, and I'm really thankful for the interest you're taking in what we're building at G Squared, and we'll continue to grind.
Awesome. Yeah, it was awesome. Have a great day.
Thank you. Take care. Bye-bye.